When it comes to generating additional passive income, an investor's greatest dream is relying on the best dividend-paying ETFs. Considering that equities of this nature typically have high dividend yields, since they are a group of connected companies, they are typically considered safer than conventional stocks. Some of the most well-known dividend-focused ETFs available are QYLD, SCHD, and NOBL. And in today's video, we will talk about an ETF that has been really popular among investors, and we will discover whether it is for a real good reason or not. Hey everyone, welcome back to the Dividend Bear channel. I am happy to see that you're watching our videos once again. In order to improve the quality of the channel, I would like to ask each and every one of you to comment on the thing that you like about the channel, and one thing that you do not. Also, let me know what video I should do next. Without further ado, let's get into this one. Today's ETF we are going to discuss is none other than QYLD. Let us define what it is first before going straight to the risks and advantages that come along with it. So, to start, the Global X Nasdaq Covered Call ETF, or better known as QYLD, is very popular among investors. Why? Because not only does the fund pay a 12% dividend yield, which is absurdly one of the highest you will find in the dividend stocks, but it also delivers cash in your pockets every single month. What's not like a high dividend yield and monthly cash flow, right? That is QYLD for you. But before you start rushing to your investing app to load up on shares on QYLD, let us consider all the factors whether or not this is truly a good investment, or perhaps there is something that the investors are missing. As an exchange-traded fund, the Global X Nasdaq 100 Covered Call ETF holds companies in an index and offers shares of the portfolio to investors. You have a fantastic opportunity to hold a portfolio of stocks with only one fund because those shares trade exactly like stocks. To cover management costs, the QYLD levies an expenditure fee of 0.60%, which is deducted from fund assets. For now, let us look at the dividend yield and QYLD dividend history. A new investor may be misled by the present dividend yield, which is 13.62% or roughly $0.1648 per share and $1.9 annual dividend. You might not continue to receive 13.62% as long as you maintain the fund because the payout amount is frequently reduced in line with the stock price. And although the Global X Nasdaq Covered Call ETF does pay monthly dividends, which is fantastic, you never know what you're going to get. From as high as $0.22 per share last year to barely $0.1648 in the most recent dividend payment, the payout has been periodically reduced. And now the question remains, why did that take place? Why did QYLD lower its dividend? We will have to wait and see how the QYLD performs, but the fund is now selling covered call options to raise money to pay dividends. The issue is that as the stock value of the holding declines, the fund receives less payment for those call options, which results in less income being created to pay investors. Due to this, dividends will continue to track the price of the ETF, making the current dividend yield rather deceptive. Investors who purchased QYLD at $22.40 a year ago are currently receiving a yield of just 9.5% and could experience further declines. Now let's move on to the next question. How does the QYLD work? On the Nasdaq 100 index, which represents the 100 largest companies listed on the tech-heavy Nasdaq, the QYLD employs a covered call strategy. Therefore, it purchases the 100 stocks in the index, which are primarily major technology companies, and then sells call options against them. An investor who purchases a call option has the right to purchase a stock at a certain price up until a specified date in exchange for paying an upfront premium to the other investor. For instance, I could sell a put option to another investor if I owned shares of Tesla, but was concerned that the price may drop from the present $800 per share, or if I merely wanted to generate cash flow from the stock that I didn't pay dividends. You can see how this functions by looking at the last line of the fund's holding. The firm issued calls on the Nasdaq index that expire in the middle of the month for $326 million in market value, or around 1.8% of the fund's total assets. There are a few things you should take note of to better understand the approach, the risks involved, and the potential reasons why the fund may perform below average. First, to generate the capital required to pay out a 12% annualized dividend return, the fund sells calls against around 2% of its stocks each month. Although it is a relatively tiny expense, selling those calls each month will have an impact on performance. However, if the fund only uses that covered call technique, it would lose out on some of the increase in Nasdaq stocks if it sells another investor the opportunity to purchase those shares at a lower price. That explains why over the past 5 years, the QYLD has significantly underperformed the Nasdaq tech stocks. A further flaw is that the QYLD loses the chance to increase in value if one or more of its over 100 stocks perform exceptionally well. Constellation Energy and Ross Discount Stores are examples of non-tech stocks that tend to have slower growth and returns than growth stocks. Right now, let's move on to the risks that are included within QYLD. As we've already touched on some of the QYLD risks, the lower share price means the dividend falls and investors holding the stock may not get the dividend yield they expected. Since the covered call strategy means that the market rises, the QYLD will nearly always perform worse than the Nasdaq 100 equities. The fund loses out on some of the gains since it gives another investor the right to purchase those shares at a set price. Investors should be somewhat protected by the fund when stock prices decline. The loss on the QYLD is marginally smaller than the price loss on the Nasdaq 100 when dividends are taken into account though. Now that we have talked about all the good and the bad, let us now take the time to consider if QYLD is indeed worth it. Well, is it truly a good investment? I would not say it is totally a bad one, but it is not as good as many investors think either. The Global X Nasdaq covered call does offer that high dividend yield and pays on a monthly basis, which is more important for some investors, but there is what we call a trade-off. But what does it matter if the share price drops when the strategy is to hold the QYLD forever and simply keep collecting the dividend? Well, I wouldn't care because I am not selling. Even if you genuinely believe that you will keep the QYLD forever and repress the temptation to sell, a lot can change in 30 or 40 years. Even the 13% annual dividend yield won't be enough for most people to live on retirement since expenses arise. That 13% dividend return is barely $1,000 a month, even on a $100,000 portfolio. You'll have to sell the shares, and if you have to do so for less than you paid, that will be a real bummer. Therefore, unless you are certain that you can hold the QYLD forever and never sell, you will be booking a considerably lesser return than anticipated because a decline in the stock price will reduce the amount of dividends you receive. Due to this and additional risk associated with the QYLD, I would advise adding other ETFs and stocks to your portfolio. And with that, that's all what we have for you today. I will see you guys again in the future or previous dividend episodes to know what we consider best for our investments. Let me know what you think in the comment section below if you agree or disagree with me on this one. With that, thank you so much for watching, and I'll see you in the next one.